Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week, New Year special. It's a look back at what happened in the financial markets in the past year, and a look forward at what might happen in the next year. And hopefully lots of great ideas and opportunities for you throughout this show. All right, well, this was a year when much of what was expected in the financial markets didn't happen. And much of what did come in the background news didn't matter. As I look back a year ago at this show that I did, a lot of what I had anticipated in the background was pretty accurate. I expected a mixed bag for the Trump agenda, and that's basically what it was, as we got nothing new in healthcare, well, until the tax cuts came. We also didn't get anything on immigration reform or any of the other big policy items, except, of course, for tax cuts. We got the tax cuts, not really reform, but it was certainly a policy win for Donald Trump. And that had seen the Donald Trump approval plunge to new lows and then gets a bounce toward the end of the year, as finally did get something to happen. We had plenty of other turmoil in the Trump administration, certainly, with the Russian probe and Flynn and so many other things that just completely fill the news. I talked about the potential for civil unrest based on Trump policies, and we got that, as none of that seemed to really matter. Plenty of dissent. I thought that Janet Yellen would not be reapproved, and that happened, but she got another dove to take her place, as the president has appointed Powell, and that's not going to make for any significant change in policy. I expected the dollar to fall for the year and inflation to pick up, and at the time last year I said, wow, Bitcoin had moved all the way up to over 900. Well, we all know what happened to Bitcoin this year, so I expected inflation to pick up, and that really didn't happen. After a 7-year rally that we had, I expected that we would see a mid-year bear market in the stock market. Well, that certainly didn't happen. All that was potentially out there, evaluations and any negative news that we saw, including, Kim in North Korea planning to blow up the world, it appears nothing mattered, nothing at all. Nothing shook investors out of their steady buying throughout the year, and even at times getting into a buying panic. It was the 8th year of this amazing bull market, which saw the S&P 500 in 2009 make a low of 666 to get up very close to 2,700 to end the year. It was just an unbelievable, fantastic year for investors. For the stock market, like I said, I was very wrong. There was nary a dip the whole year, a steady upward movement, and really you have to go back 22 years, 1995, to see any year that was even close to anything like this without a 3% dip. That was a year back then that was just a great upside year, and that's what we have this year. As we put our 8th year together on the upside, S&P 500 up around 20% on the year, the Dow Jones Industrials up 26%, the NASDAQ up 33%, as totally not what I expected. Got huge leaders out of the FANG stocks moving up for giant gains, and the Russell, though it had moments where it had decent gains, only up 14% on the year, as the low cap stocks, which came to life as the tax plan got passed, still lagged far behind. My expectation for the stock market was that the Dow would make a high of only 21,450, so it exceeded the level that I looked at by 3,500 points, a giant miss, way off on what my expectation was for the year, and that correction that I had expected, well, forget about it. Nothing like it whatsoever. Bond market, 10 years, about unchanged on the year. If you look really closely, you had the 10-year yields about 12 basis points to the downside. The 30-year note up about 30-year bond up about 2 points on the year. What I expected was mostly correct in there. I expected a narrower year for the bond market, so less volatility in there. And I did expect that it would get a little deeper to the downside as the bear market resumed. Well, the bear market and bonds did resume, but the depth of the decline remained pretty shallow in there. The dollar, I expected that it was going to be weak. I didn't expect it to be as weak as it was, as it fell 10 points or down over 9% on the year. Interesting, that helped the gold market, but not as much as you would have guessed based on that amount of decline in the dollar. Gold up $150 on the year. That's a solid 13% on the year. Silver only up $1 or about 6% on the year. So silver definitely lagged this year. My expectations were for an early low in gold, and the range that I had expected was pretty close. We pretty much tagged where we thought the low would be, and then the rally just missed. Maybe the range was a little bit higher than we had expected, but not significant. So we pretty much got that one right. Oil up about $6 on the year as OPEC moved to hold it together as they cut their production. And we had that direction right, but it got nowhere near the levels that we expected. We expected that oil would get up to $76 during the year. And as the OPEC action fails, they couldn't even make it happen. And there's a lot of reasons that maybe are affecting oil, even though they're closing near their highs of the year. That those reasons could be affecting oil moving forward. And we'll talk about that as we look for our projection for the coming year. Now, the for the year in our stock selections, we have to go back and take a peek at what the results were. And basically, as we get into this look at our best and riskiest stocks, the results for last year, and as our predictions, we're then going to step into our predictions for the coming year 2018. So let's take a look here as we look at what we talked about last year in individual stocks. Now, basically, 2 years ago, I want to make sure that I take credit for that. 2 years ago, we did spectacularly well, where our stock picks well overperformed the market they were up by 41% 2 years ago. So we well beat the market, and the ones that we thought were risky were up on the year as the market was, but only about like the market was up. So it was really a great year of stock picking for us 2 years ago. Last year, we basically were exactly with the markets. We didn't do very well at all when you look at that. And even though some of the stocks that we picked for our best of the year did spectacularly well, some of the stocks that we picked for the riskiest stocks for the year also had big gains. It was kind of the rising tide lifts all boats. Well, our stocks that, with the stock market, gaining on the average index about 27%, our average of the top 14 stocks that we look at was up only about 27.5%. So it's pretty similar when you look at these stocks, our favorite 14 for last year. As we had the best performer for the year was First Solar, as they had outstanding earnings. They were up 105% for the year. We had Lennar and Pulte Home as great gainers. They were up 62% and 83%, monstrous gains. And the rest of them were pretty much up a little more, a little bit less than the market. FCX came on real strong, up about 47% for the year. CSIQ up about 32%. So those were nice gainers in there. We also thought the dollar would be weak, and we liked the British pound, Japanese yen. Those were up for currencies nicely, up 11% for the British pound and about only 4% for the Japanese yen. So, the market up 27% on average, where our stocks are up 27% on average. Well, that isn't really a great result when you look at that. Now, when we talk about the stocks that we thought were the riskiest stocks for the coming year, this again, about as the market did. The the average stock of the 18 stocks that we said were risky were up 26.5%. So much for thinking that there was risk there, especially in what we thought were massively overpriced FANG stocks. They were the leaders for the year. Facebook, Amazon, Netflix, Google, they had fantastic gains, 55%, 58%, 33% for Google, and just incredible upside gains. The Caterpillar, which we thought was very overpriced at the time, gained 71% on the year, and with earnings growth that has been just fantastic. Its forward earnings, which were just huge last year, now looking into 2018, are only about 20 PE. So because earnings caught up so much, as the market anticipated, and infrastructure spending is going to help them out also, that really did well. We expected the banks to underperform. They basically did. Northern Trust was only up about 12% on the year. UPS we thought was going to begin to struggle with Amazon and other online sellers figuring out their own ways to deliver things. And so we thought FedEx and UPS would have a hard time. Well, FedEx up 33%. But UPS really lagged, and that was only up 3.8% on the year. My best calls for the downside clearly were in the retail category, as JCPenney was down 62% on the year. We thought it would go to $2 and eventually file bankruptcy. It did get close to $2 in the twos, so that was by far my best call for the year. And then we saw a UAA Under Armour fall sharply, also 46%. And we said that was a very damaged stock. It's come back some, even off of a worse picture in there. So there was overall, as far as saying that these stocks were risky, you can see they actually overall were not. And as the market rose sharply, it was really driven by these tech stocks that have seemingly not wanted to stop until maybe pretty soon as we start to look at the coming year. So the stocks, when I look at stocks for the next year, essentially I look at several different categories. I look at price patterns. I look at the cyclical patterns, of course. I look at valuations. I look at the story, the background, what's behind the stock, what I think is going to go on, and then there's some intuition added to that also. So as we look forward, we're going to look at these stocks with our thoughts about what's going on in the background also. So let's just talk a little bit about that background news that I think is going to affect the markets outside of anything that is geopolitical that can make a significant difference. I'm not going to mention any of those or make any guesses on that. But here we are in the new year, and looking back at the what happened in the last year, and certainly what I want to do is learn from that. So it's kind of learn and improve and believe. And if you take those steps, it really elevates your ability to be better in the next year. It brings actions that bring positive results, and that's what we really want to do: learn, improve, believe, and then that supports the positive actions to do better. Just one little promo I'm going to throw in here, and that is our workshop, the 5 Essential Building Blocks to Successful Trading. This is an amazing workshop. It is 6 videos that bring together everything that I have learned as a trader for 43 years, and as a certified personal growth facilitator for the last 23 years. And I put that all together, and it's just an amazing workshop. This is the perfect time for you to go and subscribe to that workshop. Just go to our website, go to the top of the page, look for workshop, and click on the 5 Essential Building Blocks to Successful Trading. You will really be excited when you take this workshop, and I have just so many great comments from people that have taken it. So as we look to learn, improve, and believe in what in the great results we can bring, this is really something that can help you. So let's talk about last year, this year. Last year, investors focused very much on expectations of the Trump administration's agenda. No matter what happened in the background, as we said, their total belief was that tax cuts were going to bring better earnings for corporations, that the money would flow to people, lower tax rates for the middle class was going to help, the money would then get spent, and no matter what, they couldn't get shaken from that belief. And essentially, they kept buying stocks throughout the entire year. This year, I think the attitudes are going to be similar, but it may bring different results. So in other words, investors thinking they need to be invested, well, in something, right? And that could be a whole different picture of the nature of what gets bought and where the money comes from. In other words, what gets sold in order to make the investment changes that I think are coming in the next year. Infrastructure spending is likely, and I think that if you add that stimulus, and when I say it's likely, it's because I think the Democrats can't avoid passing it. I mean, spending is what they do, and they'll hardly be able to walk into an election and without people turning away from them if they're not voting for building bridges and fixing roads. So add that to the tax cuts and the stimulus from that, and a 4% unemployment rate. You're just set up for an inflationary pop in here. And while stocks moved up in these recent years, commodities have really languished, and I did some recent videos on that, talking about the huge disparity. I think that 2018 brings a big change in that. 2018 brings, number one, much higher volatility in all markets, and number two, big sector shifts. In other words, the high-priced stuff that they have been buying all along in here are likely to get sold, and that money going into commodity sectors. In other words, currencies, which are basically battling each other for valuations. I think that you might see some narrow gyrations in the currency markets, but I think that currencies will fall pretty sharply relative to real assets. We saw that in the stock market as money moved into stocks and out of cash essentially the whole year long. And when we saw this phenomenal move into cryptocurrencies, highlighted by the move in Bitcoin, and also the massive discussion about the blockchain technology. So there's I'm bringing a little bit of that into the analysis in here for the coming year, and I think that The Bitcoin move is just the signal that move into real assets is just starting, and that's going to cause some pretty big sector shifts in the stock market. So when I look at the stock market, there's some repeaters in here of the ones that I think are going to do well and the ones that I think are going to do poor. Specifically in the asset-related area, the stocks that I think are going to do well are in that category, the gold stocks specifically. There's in the riskiest stocks for the year, I think that there's repeaters in there also, and it's stuff with very high valuations, and also stocks that have put on negative patterns that I think are getting set up for declines. So again, I'm looking at patterns, valuations, the story behind them, and my intuition as we look at these particular stocks. We're going to start out looking at the riskiest stocks, and I'm going to tell you why I don't really like them, and then you'll be able to make your own decisions. A lot of these stocks that we're looking at in here that I don't like are near their highs of the year. Some of them are just stocks that have bounced after doing at some point poorly in there. So here is my list of the 15 riskiest stocks, the ones I believe have the highest probability of declines, and maybe some severe declines, in 2018. Here's that list right here, and I'll just give you a few ideas about why I think something is bad or good. Target, plainly, is not competing on the online world. Now, this is not a super high valuation at a 14 PE, but the earnings growth prospects in Target are not great, and this stock, compared to Walmart, has really done poorly. I don't think that they're going to catch up at all. I think investors are going to get very disappointed in there. The ANF is the next one, and as you could see, the first 5 that we're talking about are in the retail category. ANF, this stock is projected to earn 18 cents on the year. I mean, it's extraordinarily high at 100 PE. I don't think that this stock has any kind of a turnaround in here. I think it just simply gotten a bounce. The next one is Walgreens Boots, WBA. This is a clearly negative cycle, and Amazon is going head-to-head with this one on pharmaceuticals, and they're going to make it so easy to get delivery, and Walgreens is just in a whirlwind of trouble, if you ask me. I was long the stock in a long-term holding, and I have sold that out. So it's, in my opinion, a very negative cyclical pattern. Dollar Tree is massively expensive. It had a huge run at the end of the year. And I think it's a play on money coming into people's pockets and the lower taxes, and extraordinarily overdone. I think there's a huge amount of risk in there and super expensive stock. Amazon, well, talk about valuations. It's at a 300 PE right now. And if you take the most optimistic look at what they're going to earn in 2018, it's at 146 PE. This is a returner from last year, as I was completely wrong on it. And again, I'm going to stay with what I believe is a massive overvaluation in Amazon. And though I think that the patterns are set up for potentially a little higher prices early in the year, I think at some point this year it's going to get hit. Federal Express, remember I showed you that UPS did poorly for the year. Federal Express up 33% on the year, did much better. This is going to really suffer from the Amazon effect at some point, and I think Federal Express has got almost no upside potential and a lot of downside potential. Tesla, this one is burning money at rates that are incredible. The competition is just growing and huge. The losses just keep mounting. They did a horrible job with the Model 3 as far as their production and deliveries on there. I think that Tesla could lose $100 plus during this year. I think it's one of the riskiest stocks we're looking at in here. Visa, this is a crazy PE in there. This one we talked about last year, and it went up for the year. In a stock like this, 25 PE projected for 2018 is just nutty. It's massively overvalued. One little problem, and the stock is going to get hit. Square, this is a 90 PE. This was a Bitcoin play because, well, they're going to be taking Bitcoin. But who has Bitcoin to spend when it's so massively volatile? Nobody's going to be using it in any significant way, and Square is just plainly massively overpriced. I think you'll see a dip in there of 30-40% sometime during the year. I'm looking for a big decline. Domino's, we talked about this last year. It did not do well in 2018. It was down a lot worse and then made a comeback, so it well underperformed the gains in the market most of the year. It has a massive head and shoulders top built in there, and we think that the stock's going to move significantly lower. The pizza market has to be saturated. I mean, how many more can grow? And I've seen the commercials now on pizza insurance. I mean, is that what they have to do? Is give you insurance that your pizza's going to come there without getting trashed? So I think it's getting, their advertising is getting hokey because they're running out of ways to grow the companies. Lots of competition. I think it's going to get hit in a very big way. Domino's. Yelp, this was a stock that I have not liked whatsoever along the way. It had some rumors and a big rally. 180 PE right now. If it has the best earnings it could have, the PE is going to be 110. I think it's crazy overpriced. CVX, this is the only asset-related stock that I think has a lot of risk. This got a big gain on the tax plan and a little bit of boost in oil late in the year. If there's any energy stock that I think has got risk, it's CVX. I'd much rather own Exxon in the large internationals than it would be CVX. But Exxon is not one I'm talking about either because, well, I'll talk about what I think is going to happen in the energy markets in a couple moments. Autodesk is another one. The stock has massive valuation in there. It had a huge move. There's going to have to be some earnings growth that comes from I don't know where for that stock to improve. We think it might have a little more upside, but we think there's a pattern in there, shows it rolling over, and a ton of risk in Autodesk. CRM, this is another valuation play and another return for us. It had a good year last year, even though it was well overpriced. So Salesforce.com, CRM, looks to us like it's got very excessive valuation and risk. And the last one is Netflix. It's got a 187 PE. It's best case for them is for the PE to fall to 82 if they do spectacularly well. And we think that the valuation, the costs for production, the competition, anything can happen on Amazon Prime, the Disney problems that they have, we think Netflix could lose 25% or more in the coming year. It's a very risky stock when we look at that. So that is the riskiest stocks for 2015. Now let's look at what our favorite stocks are, and I'll tell you why. So here are my favorite stocks for the coming year, my favorite 15. The first one is Delta. Delta is an 11 PE, and the stock looks spectacular. It's I think that group is going to do really well. Valuations are good, but Delta to me looks like the best of them at all, and I think you could get a pretty sizable gain out of Delta for the year. You know, last year I said that Intel was going to be the turnaround stock for the year, the born-again stock. It was up 27% on the year, Intel. This year, IBM is my born-again stock. It's, to me, this move that it's making into blockchain technology is going to be meaningful for it. Blockchain is going to be massive. Forget Bitcoin, forget cryptocurrencies. They're built on blockchain. It's blockchain that's the technology that's the key. Now, you know, IBM is moving significantly into blockchain, and it's anticipated that it's going to drive their cloud sales. Now, Amazon has owned the cloud with Amazon Web Services, and now they're not so much able to run the pricing like they used to. And now with Amazon's cloud growing and moving into blockchain and servicing very, very big companies, as they move into that way to track their business using that great new technology, I think IBM is going to do fantastic. Micron has had a massive move for the year. We have liked it all year long. It's a repeater for us, as we think that at a 6 PE, that earnings, the stock just can't move fast enough up to keep up with earnings. There's even room for a little mistake in there during the year. I mean, it is very cheap stock. It's just done a great job in keeping up with the present technology, and their products is strongly in demand. Really liking Micron. Also in the semiconductor category, this one is an 8 forward PE in Cyprus, a very positive pattern, so that's a beautiful looking stock. Morgan Stanley, this may be the best value of all of financial stocks. Really liking that. We think it's got the highest probability of gains in the financial category of all the stocks that we're looking at. Best value, we think it's going to do well for the year again. I like it better than I like Goldman Sachs. Applied Materials, well, that's semiconductor materials, and if we like semiconductors, we think there's going to be great demand for their materials. Really liking that one significantly. Now, as we start to talk about the things that are in the real asset type category, Cliff has a 9 PE. This one often moves with FCX and other material stocks. Valet is another one that has been looking really good. Some of the other foreign ADRs, BHP Billiton, they're all strong looking stocks. Cliff is only a 9 PE. This one has got a great possibility of very significant gains during the year. I think it is way undervalued, and I think they're going to come after it in a big way. CNX, Consol Energy, CNX Incorporated, they spun off Consol, but still it's a good representation in a lot of energy mix and coal. So I like the pattern in there. I think it's a strong pattern, strong valuation. Nucor is our pick in the steel category. This one to us has the best pattern and only at a 9 PE, strong valuation. The other steels look good. Steel Dynamics, U.S. Steel, don't have any problem with those. But Nucor to us is the best of those patterns in there. Schnitzer, SCHN, that also looks pretty good. SunPower. Now, last year we did well in our picks on the in the solar category, and First Solar with fantastic earnings drove that move. SunPower, we think, is the stock for the biggest potential move for the group for the year. It's pulled back a little bit, but not much, and we think you could get a very solid gains in there. I wouldn't be surprised to see 30-50% gains on the year in SunPower. So here's the big plays for us that we think are very important, and we're going to talk about the gold market in a moment. GDX last year, was up while the rest of the group was mixed. Just the heavier weights maybe did a little better. We think GDX is going to have a solid upside year, and there's strong buying starting to come into the gold and silver stocks. So you can see in there we like GDX, we like AG as the silver stock that we think has got the highest probability of a high, a good size return on the upside. Newmont has one of the strongest patterns in there, so we're really liking that one for the gold stocks. And then we like gold and silver, and I'm going to tell you in a moment what my projection is for the gold market. But we think that silver will probably, on a percentage basis, overperform gold. So like I said, Bitcoin had the big move, and we think that the Bitcoin market is just the beginning of the flight from money into real assets, and this big sector shift that we think is coming, and that's why we think some of these stocks that were really high priced, the money's going to come out of them and make this sector shift into the stocks that represent real assets. And infrastructure spending, of course, and the prospect of it and the talk of it that's going to start pretty heavily is going to drive that sector. You see gold starting to move up pretty steadily at the end of the year. Please watch our gold market big picture analysis that we did on Thursday the 28th. If you're not a member, please become a member and support us so that we can keep bringing you all of the great information, and watch that video on the big picture on gold and silver and the mining stocks. We look at 19 different stocks in there and give you the analysis, and you'll be amazed at the cycle analysis in there. So I really want to encourage you to go watch that video. So now we're going to look at my market predictions for 2018. This actually says 2017, so there's a mistake on there. But this is my predictions for the coming year for 2018. I'm sorry we have a mistake on that slide, but this is what we expect. So for the oil market, now you can see in here, last year I thought the oil market would get to 76. I think that the oil market this year is going to have a bit of a tougher time. There's several reasons for that. First of all, I think that this OPEC push to cut production eventually is going to fail. They're going to have problems with that. And I think that oil shale, once you get up in this 60-65 area, production really picks up. There's a huge move into electric cars coming, and that's going to affect the gasoline usage and affect oil usage. So, I talked about the big competition coming on for Tesla, Volvo in 2019 going all electric. Almost every single car company coming out with electric cars that are going to compete with Tesla. So this huge move into electric, I think, is going to be a problem. I kind of expect us to see a first half high in the oil market around 65, and then later in the year falling to 51 and potentially lower than that. For the gold market, I think that the low for the year is going to be around 1287, and I think it's early in the year. I mean, if we get it, I think it's in January. And then I think it's a solid uptrend for the rest of the year. There are important Fibonacci extension numbers and retracement numbers all coming between 1590 and 1620. That's why I'm picking 1620 as the high price for the year. As you can see, I'm very bullish on gold, and I think that's going to be driving the GDX and those gold stocks significantly. You really want to watch that video I did to see some of the lower price ones that can really have giant moves. The dollar, I think, this battle of currencies will continue, and it's really which one loses the most value to gold is how I look at it. I don't think that the currencies are going to have much of volatility in the year, but I think that volatility is in relationship to the gold market. The dollar, we're expecting a low of 88.50. There's another significantly lower low than that that's a potential, but I just don't think it's going to get there. I think the high of 95.50 probably going to come in the late first quarter, beginning of the second quarter, and then accelerate then to the downside as they start talking about Japan starting to raise their interest rates, and that's going to kill the dollar when that happens. Here's the big call, and there's going to be people looking at this that may say, well, that makes sense, and some people would say you're insane. I think Bitcoin, the bubble will burst. Now, again, don't confuse this with blockchain. And that all of these people that have been bullying it up, and whatever that 1,000 or some people that are holding the majority of Bitcoin are going to bail at some point. Traditionally, bubbles, when they crash, they lose about 80-85% of their value. So I think that Bitcoin probably, early in the year tries to make a new high. In the first quarter, maybe gets up to 20,500. But then I think there's ultimately going to be a huge crash. 19,666 might end up to be the high, but we'll see. But maybe one more time over there. And Bitcoin getting under 5,000, 4,500 is my call. Bond market, narrower year is what I'm looking for, with, again, a downward bias. in the bond market. I think the bear market continues, but because you can see below, I think there's a stock market correction coming. There's probably a period in there where the bond market does better. So I think overall the range will be narrow. Looking at 120, 110 as a low, that would be about just over 3% on the 10-year note. And the high being 125.04, and I'm going to guess that's going to come at the point of the low of the stock market correction, which I think is going to be coming this year into the late spring, or actually late spring is when I expect that to happen. For the stock market, I'm going to do a big picture analysis and explain to you where this analysis comes from in the next week. So if you want to see that, again, that's for our members, so you'll have to be a member. The S&P 500, I expect us to see a low sometime in June. Could be late May, could be early July, but June is really where it all kind of lines up to, mid-June, based on the big patterns I'm looking at, of 23.77 on the S&P 500. That would be a decline of somewhere around 12%. So I'm not looking for a bear market, but I'm looking for a significant correction and much higher volatilities throughout the year. I think that 29.15 high comes late in the year. In other words, it has a correction and then comes storming back after that. So we'll kind of look for a bungee jump sometime into June, and then a high moving towards the end of the year of 29.15. And I'm looking for a ultimate gain on the year. Yes, I'm calling for the 10th year of gains of this bull market. For the year of maybe 3 or 5% on the year. That's after a big dip and then a big move to the downside. So wow, we covered it all. You get my predictions in there. Don't ask me why I'm in the prediction game. It's something that I've done for a lot of years, and it's amazing, even in years that, like this year, were on the tough side, where I maybe performed as the market did and not any better. Overall, I get a tremendous amount of questions coming into December. Are you going to do the year-end show? Are you going to do the year-end show? So lots of people look forward to this, and I put a lot of work in it, as you can see, because I have to analyze all of these markets, especially on big picture type things for projections. So we'll see how that goes. We do that every year. Hopefully you will all be here watching my show next year when I take accountability of how I did. Hopefully I'll be here. And that's a key. We really appreciate all the support you give us. There's lots of ways that you can support us by becoming members, by buying our workshops. I have an amazing workshop coming out on cycle analysis. It's due sometime probably in March. It'll be 18 or 20 videos. It's unbelievable. You will never learn as much about technical analysis and cyclical analysis as in that video. So look for, as in that video series, so look for that coming. Support us, become a member. I want to wish all of you a fantastic new year coming. Remember, learn, improve, believe, and let that drive your actions to success in this coming year. Happy, healthy, prosperous to you and your families. I much appreciate all of you for your loyalty. Send me emails, let me know what you think, and I'll see you in the next year. Thank you.
Well, I'm going to the city and I'm gonna do a steady show.